Chris Preston.
And I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the 50-plus year history of Cabot Wealth Network, coming to you, as always, from Madison Avenue Studios. There, I remembered it that time. Um, Brad, before we get into the investing discussion today, you have a new family member of sorts in your house, or a new big addition to your property. Tell people what that is.
So a little bit, it felt a little more spur of the moment to me than I think it actually was. My wife had been thinking about a new vehicle for a number of years. Both our cars were bought off, like slightly used off of leases. They're both about 10 years old. Her Jeep had about 100,000 miles on it, and she really loves the Mustang Mach-E, so we are now half full electric. So we went over the weekend and snagged one of the Mach-E's,
But
eruption
that is a
green.
full electric, just to
Yeah,
clarify.
full
Yeah.
electric.
Now, have you
And
gotten what is it, 240 volt? Are you getting that installed in your house?
we
Yeah.
currently we have it on the wall charge trickle charger, which gets about 3 miles to the hour of plug-in time. So it's really not super tenable. But we are having multiple electricians come out and give us bids for the 240, where we get like 20 miles per hour of charge time. So much more feasible. Uh,
Are, are there nearby places where you can plug in? Like our library right around the corner was at a plug-in place for our
we've got, so we're not that far from like dealerships, which weirdly have a lot of public charging available on them.
yeah.
So we do have some nearby chargers. There's a supercharger like a mile away, but when we moved down to Phoenix, we both work remote, so it's not like we're commuting every day. And we have two other vehicles right now. We'll see if we keep both, but we've got plenty of like road trip mileage from the other vehicles. So given that, we're going to put a few thousand miles a year, 6,000 miles a year on it, seems like a good outcome. We've sort of been planning on doing this for a number of years. When we moved down, it was like, hey, our next vehicle is going to be full electric, plug-in. Maintenance is super low. Like there's no maintenance in the next couple of years at least. Um, and it really fits our lifestyle well. So good pickup.
So you bucked the hybrid 1 foot in, 1 foot out trend, which is what we adopted when we bought a hybrid almost 2 years ago now. You went full electric.
Yeah,
Maybe you're
yeah, just
starting a new trend.
no, we're just in that sweet spot of like, Ford, I pulled up some stats and shared with you earlier. Ford, I think 4% of their vehicles were full electric, and they project that like the total market share is going to be like 10% by the end of the year, up from like 7.9.
Yeah.
There's a sweet spot of people for whom it will work, and for whose lifestyle it's appropriate, and we happen to be in that sweet spot. If I were any further away from like downtown Phoenix and the places that we go, I don't think it would be tenable. Or if we had a daily commute, it probably wouldn't be super tenable, especially if it's a long drive. But given how we use our vehicles, and that lack of maintenance thing is big. There's no internal combustion engine, there's no fluids,
Yeah.
there's nothing. So
That's nice.
especially, for my wife's daily driver, given that she doesn't drive on a daily basis, it hit the sweet spot. I do think that for most of the population, the hybrid thing is still the way to go, though.
Yeah, the lack of maintenance thing is nice. Even with a brand new hybrid, we got a Volvo XC90 hybrid recharge that we have had to service a few times already. Nothing major, but not having to do anything to it is
Well,
nice.
because I assume you still have some sort of like oil change component, because you
Yeah.
still have a combustion engine in there, and
Yeah.
you've still got fluids and things of that nature to be concerned about. I
Right.
guess, I mean, it's basically an electric car with a built-in generator, right?
Yeah. Yeah, pretty much.
So,
Um, but well, congrats. Yeah, maybe we're seeing the shift for, I mean, prices for full electric are coming down, as we've talked about on here. The arms race, the race to the bottom price wise with Tesla versus
and
BYD and others. So
you know,
becoming more, that's becoming less of an obstacle.
well, and that was a big thing for us. Like, I'd mentioned earlier, our habit is buy something that's 2 to 3 years old, that's come off a lease, that's low mileage. Let somebody else take the new vehicle depreciation hit. But in the pandemic and then post-pandemic, used car prices have normalized pretty much essentially
Oh,
with new car prices. There is
yeah,
not that much of a discount from buying something that is lightly used. I mean, there is still a discount there, but the scope of it is a little bit lower.
yeah,
Um, and that was enough to change our behavior. I mean, that plus all the lifestyle stuff we've talked about, but it's just there's less of a value add for getting that 3-year-old or 2-year-old car versus getting the new one. And the other upshot with we leased, the other upshot is it simplifies the tax credit process because the EV tax credit is non-refundable, so you essentially have to plan your income to have an extra $7,500 tax hit baked into your annual income, which is, it's a pain in the butt. It's not impossible, but it's certainly a pain. And then with the lease though, the lessor takes the tax credit, but then hands it off as an incentive. So it simplified that process for us as well, getting it on the lease.
yeah. And just to clarify, your wife's car, right?
My wife's car, yeah.
When will you be allowed to drive? 2026, maybe?
That seems about right.
Yeah.
Oh wait, no, it's only 2024. Sometime in 2020, excuse me, sometime in 2025, I will take it for a spin. I have not yet. Like I was gonna go grab groceries, and it's like, what if I hit a nail? What if somebody parks too close and dings it? Like it's too early for that. End of this year,
Wow.
beginning of next. Maybe we'll give it a shot.
Wow. Yeah, that's like real life doom scrolling.
Hmm.
What could possibly happen?
Yeah,
Um,
that's how my
okay.
brain works.
Let's shift to investing. Tell people what we're going to talk about today.
So we are going to talk about moves by China's central bank to improve economic conditions in the country. Had some fiscal stimulus measures, and then overnight there was news of possible additional action by them. We are going to talk about value stocks having a moment, a little bit of a resurgence there, and we are going to talk about recent information that came out about retail investor sideline cash. And then after that, we're going to have Tyler London on, and he's going to talk about small caps and Cabot Small Cap Confidential. But before we get to that, as always, you are on the clock today to defend a take. This week, it is the market bottom came 2 months early because of the Fed. You have 90 seconds, and you may begin.
Yeah, so as I've talked about, the last 4 years, the second half of the year market bottom has come in October. It was pretty pronounced the last 2 years. This bull market, which is now 23 months old, started in October 2022, and then a lot of people think sort of the real phase of this bull market started last October after that bottom. Thought maybe something similar was coming this October, just based on that trend. But it appears that the bottom may have come in the first week of August. There was a significant drop off in second half of July, early August, in part due to the weak jobs report and the Japanese carry trade and all that stuff, that domino effect. S&P down more than 8%, NASDAQ down 13, 14% from its highs. I think the reason, as you know, as you mentioned at the top, the Fed timeline. I think that changed the whole timeline. It being their first cut being in mid-September, third week of September, sort of bumped things up a couple of months. Whereas, in the past few years, the bottom may have come the first half of October. Instead, it came out the first half of August. Does it mean that there won't be some choppiness in the next month or two, especially prior to the election? No, but I do think the bottom is in, and in a little earlier than it's been the last few years.
Man, you hit the post on that. That was spot on.
It felt like I was hitting the post. Yeah, I was proud
We
of
need to
myself.
put on like a 20-second shot clock or something, just so that's like because doing
We
it
got to
every other
figure out a
week,
way to get something up, a clock up.
some sort of warning where it's like, hey, you got 20 seconds. I don't
Yeah,
know. Yeah, the seasonality thing, right? Like historically, it's sort of we're still in the stretch of the worst 10 days for the market historically.
yep,
But the fact that the Fed basically implied that they missed a cut in July and should have been cutting earlier, I think obviously a net positive, and it's probably enough to override any seasonality that was in the market. But it's
yeah.
like the overall conditions, the macro conditions, and the sentiment around that are swamping the seasonality and the negative that would have come with that. it appears. I mean, like technically markets look good. Stuff's at
Yeah.
all-time highs. Nasdaq's broken out of some like downward consolidation it was in. So everything is so it seems like all green lights to me out there.
Yeah. And I think every time we come on here and say like all systems go, then there's a pullback. But even if there is one, I don't see it dipping. I mean, that would be quite a pullback at this point. S&P bottom at 51.86 first week of August. We're now at 57.22. I don't see a 600 point dip in the next couple months, or even before year's end. Will there? I think things will chop around a bit as they have sort of done in the last week since the initial post-Fed cut fervor. It's sort of been a little choppy. I could see that continuing, and maybe even another sort of leg down. But I think the lows will be higher going forward the rest of the year, calendar year.
Well, you and I were giving each other a hard time about the fact that all Cabot analysts came in over the summer and everybody was super bullish.
Yeah.
And then we had a correction and then we hit new highs and then we had another, 5 to 10% correction depending on what you're looking at. And where are we now? We're at all-time highs again, right? Like
Yeah.
that the short term it's important to zoom out a little bit with these things because there's always going to be some sort of short-term news headline, but like that long-term trend is firmly heading up right now. Um, so yeah, maybe we chop around, maybe not, but
Yeah.
it definitely feels like, end of the year, we're probably higher. More importantly, middle of
Yes.
next year, it's, barring a catastrophe in the economy, that also seems like we're probably going to be much higher.
Yeah, I mean, but by chopping around, I meant mostly pre-election. That's kind of the
Sure.
pattern, or maybe even just the next few weeks. I do think we'll be higher by the end of the year, and possibly even significantly higher. Let's move on though to our big three. Number one, we've been talking so much about the America Central Bank. Why not talk about China's? Well, they are in the news. People's Bank of China made sort of waves this week saying they're going to cut their benchmark interest rate and lower the interest rate payable on existing mortgages. In addition, it's offering $70 billion to funds, brokers, and insurers to buy Chinese stocks. Instead, it would put up another 300 billion yuan to finance share buybacks by listed companies. That's a lot. Clearly they're tired of all the slow growing economy and the accompanying slow growing market or no growing market. Will this work? Will this be the thing that jolts markets and their economy?
My initial instinct was no.
Yeah.
I want to or I want to share a quote that I pulled from Barron's from an opinion piece from William Pesek. Um, this is his quote in its entirety. The frustrating thing is that Beijing knows what's needed to turn things around. A bold strategy to strengthen the finances of good quality developers, incentivizing mergers and acquisitions, improving capital markets so that consumers stop seeing property as their only investment option, and creating social safety nets so that households spend more and save less. So that's William Pesek's quote. That just looking at the scale of what they're doing, that sort of mirrors what my instinct was, which is great. You're making it easier to lend money to people to buy houses. They're reducing the initial down payment required on property as well. It's like, but what incentive do people have to throw what is at this point good money after bad into property? And I know culturally and economically, like property ownership is sort of the only savings vehicle. Something like 70% of Chinese households have property as their primary savings vehicle. But if you've built more property than you need, it is adjacent to a Ponzi scheme that's sort of blown up, right? There's nobody else to buy the property. So what ended up happening though overnight is there was a lot of talk of actual fiscal stimulus. They attributed it to the 75th anniversary of China's Communist Party, um, but like cash handouts for people, stuff like that, to which China's really been resistant to. They don't want to turn China into like West or East West, I guess is how you would phrase it. right? Where it's all spending and borrowing. Like they're trying to avoid that, but they're making some bigger stimulus new moves that does seem to be heading in the right direction at least. So I think
Yeah.
that the odds are better that it works than that it doesn't at this point, assuming that they get serious about handing out cash.
Yeah. I mean, just to play devil's advocate, or I guess angel's advocate in favor of what China's doing here. We just been talking about how the Fed is sort of limited in the U.S. is limited stock market, and now that they're finally cutting, it's sort of the green light. And then we saw what stimulus measures did in 2021 to both the economy and the market. Now eventually we had to pay the toll, pay sort of the tax on that, and there are all sorts of issues with inflation and everything. But I wonder if, at least in the short term, some of these measures will sort of jumpstart their market, if not their economy.
Yeah, like the tough thing. I think the tough thing is there is a lot more resistance in the last year than there had been in like the previous decade to importing cheap Chinese goods. Tariffs in the US, there's tariffs in Europe. Um, that's really like that's their only move as far as getting people to spend money on their economy is either property or it's global exports. And if nobody's spending on property and apparently local governments are pushing or not pushing back, I don't think you have the luxury to push back in the Chinese system, but local governments are a little bit more hesitant to incentivize property development because there's still a lot of pain there. Um, and if your only other move is selling cheap imports and people don't want your cheap imports anymore, that that could still portend long-term pain. But I don't know. China is pretty undervalued right now. It's had essentially a lost decade. It certainly seems worth a flyer. I'm
Yeah.
not I'm not full portfolio. I'm not going full portfolio into China, but as a flyer, yeah, yeah, pick
Yeah.
some winners. Pick some stocks that you really like that are going to outperform, and park a little bit of money there. I know a few of our advisories have some China plays that have worked out really nicely lately.
Mhm. Yeah, I think we'll have to get our go-to Chinese stock market expert Larry Chung onto a podcast
Yeah,
soon to do a deeper dive on this because he's always had a lot of good insight there, and maybe to insight on how much of an impact this could make. Let's move to number two. Value stocks back to the U.S. Are having sort of a resurgence lately. Up the VTV, which tracks some of the more prominent large cap value stocks, um, is up more than 9% since the August bottom. Now it's still trailing the S&P. S&P, this is as of yesterday. S&P was up a little over 10%, like 10.5%. Still trailing, but the gap has narrowed. Value stocks have famously, maybe infamously, lagged growth stocks and the rest of the market for years now. What, decade plus?
yeah,
And I run Cabot Value Investor Advisory, took it over in April, and that's been hard to find huge home runs in thus far. So maybe that'll change. Although things have been perking up lately, and I've noticed it there. I've been taking a look for growth at value prices approach. So, sort of similar to Warren Buffett. He's got Apple and is it Pinduoduo in
okay.
there?
Hold on,
Alibaba?
hold on. You just compared yourself to Warren Buffett.
No, I'm not comparing myself. I'm following Warren Buffett.
Okay, okay, good. It just caught me off guard. You're like, yeah, growth of value prices, like Warren Buffett. I'm like, hey,
No,
I
no,
respect you, but I don't know if you're a Warren Buffett.
I'm definitely not a Warren Buffett. No, although Warren Buffett's been slipping lately, but well, that's another story. No, I mean he is the value investor. You know, he's the god of value investing. Yet he has Apple and
Yeah,
is it Alibaba in his portfolio, and or maybe sorry, BYD. BYD. That's what I'm thinking of.
yeah,
Several other like growthy stocks, but he just got them at value prices after the big dip. Um, but maybe pure value stocks will have their day a little bit more here will the broadening of the market rally, send value stocks, put them suddenly in the driver's seat? I don't I don't think so, but we could see similar to what we've seen the last 6 weeks or so, where value stocks have almost kept pace with growth stocks.
One thing that caught my eye in something that you'd written, I think you said that value stocks have returned like 19%, 18.8% or something like that over the last 5 years.
Yeah.
So half of the 5-year return for value stocks has happened this calendar
Yes.
year.
Yes.
That's a lot of momentum.
So half
That
of it has happened in the last 6 weeks.
Oh, in the last 6 weeks. Okay, yeah.
Yeah.
So I
Yeah.
undersold that one. Yeah, that's a lot of momentum. Um,
Right.
I I think you're right. I think that the leading elements of the ongoing bull market are going to be the growth plays because that's where everybody wants to be, right? You don't want the stock that's returned on average 4% a year for the long haul, but I think that there's a lot of value there that I should have had a better way to say that, but there's a lot of
There's
catch up
value and
value.
value. I'll write that down.
And especially as people get off the sidelines, if you're a more conservative investor and you are sitting in cash, or if institutionally you're capped out on how much growth focused stuff you can buy, um, undervalued stocks right now with a lot of room to catch up are pretty attractive.
Yeah.
And
And just to clean up what you said, over the last 5 years, value stocks are up 55%, but
mm,
since the start of 2022,
okay,
they're up, yeah, 18.8%, at least as of yesterday. You know, they were, uh, they had gone nowhere from the start of 22 and 2022 to the end of last year. And even, first couple of months of this year, still nothing. But they've got some traction, back in the spring or late winter. And then now this is sort of the biggest push they've had in years. Some good signs there. Number
yeah.
three and the big three. There's a survey of individuals, investors, about how much cash they're holding that you wanted to. This is your baby. I'll let you riff on it.
So uh, there was a survey associated with it, but a lot of the retail brokerage firms have sort of assessed the cash balances on the sidelines. Traditionally, retail investors park about 10% of their portfolios in cash. That's according to uh, the brokerage firm Public. They're sort of Robinhood adjacent, where they're like app centered. Webull, which I think is the second biggest discount online broker for like I guess Gen Z, the younger generation, people younger than us. Webull came out and they said that they've got about 25 to 30% of their brokerage firms in cash. Public confirmed the same numbers, and then Robinhood had 4.8 billion in cash at the end of 2022 held by their premium subscribers, so their Robinhood Gold subscribers. And by the end of 2024, that figure had quadrupled to 22.2 billion in cash.
Hmm.
Their number of customers doubled at the same time. So effectively, the cash balances held at Robinhood doubled in the last 2 years. But with rate cuts here, there is now sort of a push to get invested. Robinhood did an internal survey and found that if rates drop to 4.25%, most of that cash is going to stay where it is. But if rates got down to about 3.25, then you would start seeing cash that retail investors are holding on the sideline redeployed into the market. That I think that's consistent with something you and I were talking about last
Yeah.
week, which is, if you're making 4%, it's still a solid return. But once you get down into 3%, it forces you into the market. Um,
Right. Yeah, and I think that's what these rate cuts will do. And I think that the message the Fed was sending by starting, coming out of the gates hot,
yeah.
it might have been partly making up for lost time kind of a thing. But, also saying, like, we're cutting rates and we're not going to slow play it. Here we go. And, hoping that that'll jumpstart, Well, they say they, are not concerned about the market, but maybe, there's some subtle, it's made of individuals on there. Maybe that's, subconsciously some of their thinking. Um, but the effect, I think, will be that it'll finally get some of this cash off the sidelines that's been building up for years now. I mean, I think we said what, $6.3 trillion on the sidelines, and that's been building since what, the middle of 2022 or
Yeah.
sometime during the bear market. Um, I do think it'll reach a breaking point where it'll that cash will come pouring back into the market. When
Well,
that will happen, I don't know.
the other consideration, just piggybacking on our value stock conversation, is if you are 25% in cash right now, you're not going to flip a switch and then suddenly become a hyper aggressive growth investor. If you're willingly accepting 5% on your cash or 4.5% on your cash, you are a more conservative investor. You are more likely to target companies with favorable PE ratios. You're more likely to target companies that are paying a dividend. You're more likely to target undervalued stocks that have not rallied sort of uh, unstoppably since October of 2023 or 2022 now. Um,
Yeah.
so those are going to be, I think the value stock play is a little bit, I think that's going to contribute to the catch up growth. There is the cash coming off the sidelines now is cash that was comfortable missing out on a lot of the hyper growth run that we've had lately. So I think that they're going to target some of the undervalued stocks. I don't think value is a contrarian play right now,
No.
but I do think it is still a conservative play.
Conservative play, yeah. I think it is, maybe these have been overlooked for so long that, it's a bet on the bull market spreading to, things other than, as we talked about so many times, large cap or mega cap tech and
Yeah.
AI and, all things tech. Um, okay. So let's welcome on, speaking of market broadening to other sectors and sizes of companies, let's bring on a small cap expert, Tyler London, in just a second. We welcome on Tyler London, Chief Analyst of Cabot Small Cap Confidential and Cabot Early Opportunities. Tyler, small cap stocks the last few years have been like Charlie Brown with the football. Every time it seems like this must be they're due. They're due. It's time for small caps to really get going. The market's in gear. Small caps are about to join, and the football gets pulled away. Now, I think your premise has been that once the Fed starts cutting rates, that'll be a true catalyst for small caps. Now that it's happened, and they really came out of the gates hot, 50 basis points. Is it your belief that this is finally small caps time?
Yeah, I think it is, Chris. And your analogy there of the Charlie Brown is apt. I think also I kind of feel like the boy who's cried wolf for like 3 years here. We've been,
Well,
talking
we've
about the
echoed you.
market.
We've been on it too. We're all, if you're guilty of it, we're guilty of it too.
I think the interesting thing, of course, like we talk about small caps as an asset class, and it is, and it's made up just like the S&P 500 of a whole bunch of stocks from different sectors, and so well, we don't want to get too into the weeds of that. But when you look at small caps now, there are structural reasons why the index hasn't been able to perform as well as like the large cap index, for instance, or the Nasdaq. But we back away from all that, and with the Fed now cutting rates, we have seen a lot of the really rate sensitive sectors of the market, not just in the small cap world, but large caps as well, like REITs and industrials. Those stocks have really been responding well, and the small cap index is pretty heavily allocated to those. So a pretty nice tailwind there. And when we step even further back and we just look at like the S&P 600 as a whole, there's a much higher percentage of companies in that index that are exposed to variable rate debt. And so as interest rates come down, again, this is variable rate debt. So like as the Fed, just cut rates by 50 basis points, they have an immediate benefit. These aren't loans that go out 15 or 20 years. It's an immediate benefit when the Fed cuts. And so that is a tailwind for the asset class, the small cap asset class, because financing costs come down. That helps with cash flow. That helps with profit margins. And again, it's in a rather significant allocation in the index with utilities and financials and REITs and things like that. So yeah, the hope here is that this Fed cut and the expectations of more does give small cap, the S&P 600 and the Russell, like that final push to kind of get through overhead resistance. If you're a technical analyst, you see like these indices keep bumping up against resistance, and hopefully they can get through it and make some nice upward progress from there.
So I'm gonna call back to one of the last times that you were on the show. I think you were not expecting much in the way of rate cuts.
Much is a kind word. 0 this year.
So
By the way, Tyler, that sparked an idea for us to do an all-inclusive hot sauce tasting episode at the end of the year where we not only punish ourselves for wrong takes, but all of our guests. So stay tuned for that.
Yeah,
now,
guilty.
my pitch to Chris was that you will gladly do it because the rate environment is so much better for small caps than it had been. It seems like the Fed is like really serious about slashing rates, getting down to like the 3% range next year. Even does that materially change your outlook? Like, I know you weren't necessarily pricing in a ton of rate cuts this year, but going out even over the longer term, are you expecting maybe outperformance and not just catch up performance?
Yeah, I mean, I think, obviously that's the hope, right? I mean, obviously the hope is that both large, mid, and small caps all do well, right? And we have like a healthy advance in the market. But if we look back over history, small caps do tend to outperform in, like 2 years out of every 5 or 3 years out of every 5. When we look over like a multi-decade period, and we meaning small caps, have underperformed for so long that just based on like if you're a mean reversion guy or gal, like there is that argument to be made, and of course you can like find holes in that argument all over the place if you want to point to specific things. But again, like when you step back and you look really big picture over like multi-decade periods, I think the potential is there for small caps to not just do well but outperform on a relative basis. As far as your question about rates, like if they get down to like the 3% range or lower 3% range, yeah, I mean the trade-off there, of course, is that we need the economy to hold up, right? That's why the Fed is now signaling more rate cuts, because they really do want to avoid the recession. There was all the tough talk in 2023 and at the beginning of this year about holding steady and raising and whatnot. So now it's more about like, okay, how do they preserve the economic strength and not crush it and destroy the labor market, et cetera, et cetera. So that's the other side of the coin, is that the Fed is still riding this fine line. And it's really just going to depend on how the economy responds.
Tyler, are there specific sectors that you're looking at to be sort of lead small caps sort of out of the darkness here? Are there ones that sort of have a better setup now, or maybe benefit from rate cuts more than others?
Yeah, well, so we talked like just when we first started, Chris, about the rate sensitive areas, right? Like the utilities, the REITs, those areas of small cap and large cap that have been moving. So certainly those have potential. I think also though there are, and to be clear, in the small cap publication that I run, the Small Cap Confidential, we're not getting into like the big dividend paying areas of small cap. It's really more growth oriented. So the way I've been playing that trend is looking at like infrastructure companies, things that are benefiting from the electrification of the grid, of the economy, data center demand, that kind of thing. And I think that there's a strong case to be made for those types of companies to do well. There's also areas like software, which of course most software companies have little to no debt, especially in the small cap area. If they need to raise money, they go out and they raise equity. by issuing shares. But there's a valuation argument to be made there. Like as interest rates go higher, those long duration assets, growth assets, tend to look more and more overvalued. And that's what happened coming out of the pandemic when the Fed started hiking rates. All those software stocks that were trading at sky high valuations suddenly looked like, whoa, way too expensive. And they just got absolutely demolished for years. That's starting to reverse course now. It's not like software looks great across the board, but we're seeing a lot more software companies look good. And both on like a technical basis, but as well as getting into the businesses, what they do. So I think there's some opportunities in software, definitely like a stock picker's market there. But we have some exposure to that in the publication. And I just wrote an article for our Cabot website talking about some opportunities there that I think look interesting. So software would be another area I think looks pretty compelling.
Is there any overhang specifically that you see for software names with AI still being sort of an unproven but maybe threatening technology?
Yeah, totally. There are definitely some names. I think when AI first, like when the whole AI trend really took off, software names continued to be relatively weak because a lot of them, there was concern that their business models were going to be totally disrupted, right, by AI that could do whatever software used to do. And I think there are areas of software companies where that is a big problem. And you can see that in a number of charts of software stocks that just look god awful. But there's, the other side of the coin. There are companies that have an AI strategy that are doing well and already, even when the AI kind of hype train began, they had products that they were using machine learning and artificial intelligence in, and those products are out in the market, and we are seeing that their customer base is responding and paying for those products and using them, and the companies are monetizing them. So there's a tailwind there for the right companies. It's just, again, it's kind of like a stock picker's market. And I think it is important to understand, I guess, like the puts and takes of how artificial intelligence may affect an individual company through its products and its customer base. That's a long-winded answer, but we cover that stuff, when we're talking about an individual stock in the publication, like how they're going to monetize AI or avoid those risks.
Yeah, I know you've got a pick. I think that is good for like, hey, if you are looking at implementing AI as a company, you actually need to do some cleanup in house first. Which,
yeah.
like, I don't recall if you had talked about that in the daily, but I do believe that it came up in the Cabot Wealth Daily. So if this has been an interesting conversation for listeners, take a look at that one.
Yeah, for sure. And that stock, what it does is, or what the company does is, they have products that help a company that's trying to implement an AI strategy clean up their data warehouse, because of course AI relies on data. And if it's all bad data, then whatever AI solutions they build are going to be just absolute garbage. So they got to get the data house in order. And so again, as you pointed out, like that's really like a company specific insight that's important to understand if you're going to own shares in that company.
Stepping back to look at the sort of the big picture, since you're a good big picture guy and macro focused guy. What it feels now like the bull market, this next phase of the bull market, this post Fed rate cut phase of the bull market, feels inevitable. What could derail that? What worries you that's out there that could sort of derail that, not just for small caps, but for the market as a whole?
Yeah, well, nice setup there, Chris, because we talked about this just a little bit before we got on camera.
Exactly. I'm setting you up.
I suspect that we share the same ones, right? Like, of course, the stuff going on overseas with Israel and Hamas and Hezbollah, and that's obviously concerning, especially for those of us that read those headlines and then read deeper into the stories. I think the election feels like it has bigger risk this year than in the past. Just everybody on each side is so gung-ho for their candidate that it just feels like that's a little bit concerning. Although you know, as you kind of pointed out during the last election, there was definitely some turmoil, but the market really took it pretty well.
Yeah.
Um, I
I feel
think,
like the risk is almost more like it being close and there being like a Bush Gore 2000 situation where we don't know the winner right away, where they're still counting the votes, so there's hanging chads or things like that for a couple months. Like the market hates that uncertainty, and I think if you
yeah,
look back at the market, and this also coincided with the turn of the century .com bubble bursting, so it's hard to know what was what, but the market didn't like that, and I don't think they would like that if we don't know the answer within 24 or 48 hours of election day.
yeah, totally. I definitely wouldn't like that scenario. I mean, we all talk all the time about how the market dislikes uncertainty, right? So,
Yeah.
to your point, that, and then I think the other one is, and this is a little bit more nuanced, but now that the Fed has cut rates and signaled it's going to cut more, like if the market were just to run higher, like too far, too fast, and it's kind of a funny thing. Like we all want that to happen when we're heavy on stocks, right? We just want that like surge higher. And then when it starts to happen and it gets a little bit too hot, you're like, oh, this feels like it's going a little too far, too fast. And what does that mean if we front load returns? Does that mean that the market's not going to do anything for 6 months or 8 months or whatever? And I don't think we're there yet, but that is something that's lurking in the back of my mind, that if the market really does run really hard, like into the end of the year, is it front loading returns, which we would certainly enjoy right now, but what does that mean for 2025? It's not really a risk if you're a long-term holder, but when we're trying to move in and out of individual stocks, and especially small caps that tend to move a lot, certainly going to be paying attention to that kind of thing on a weekly basis, because there is some market timing, right, to
Yeah.
this whole thing.
Is there a certain threshold that you're looking at? So if we front load a year of returns, is that like, hey, if we run 18% or 24% through the balance of 2024, that's is there a threshold? But I assume you get sort of what I'm hinting at.
Yeah, no, I get what you mean. I think I would look at it more like on a valuation basis than
Yeah.
like an ultimate return basis, right? Because it's easier to look at, or easier is not the right word, but it makes more sense to me to look at a chart of forward PE ratios or trailing
Hmm.
PE ratios over time relative to well, in that forward PE ratio chart scenario, that would have like forward 12-month earnings expectations baked in, right? So if we look at those kinds of charts and we look at what like consensus earnings estimates are and estimates for profit margins and revenue growth, then that can kind of give us a picture of, does this market seem like it's overvalued and in kind of sketchy territory or not? Obviously, that gets a little bit data intensive, but those are the kinds of things I would probably look more carefully at than just market is up 18% and I'm concerned.
Yeah, part of the reason that I asked in that fashion was it's something that I had, you think about that in the context of this year, especially with large cap growth, where all the recession fears and like all the doomsayer calls, it's like, hey, well, S&P 5,500, that's our end of year target, and we're there by April. And then in response, the market is just now at 5,700. So I think there's always that sort of specter whenever we have a great 6 month span or something like that. I wondered if there was maybe a firm number that you were looking at, but
Yeah.
asked and answered. So I appreciate it.
Well, what's interesting, like we all talk about as if it's like some like, I mean, what it is, like it's a big blob of 500 stocks, or in the case of small cap, 600 stocks. And so we sort of talk about that as like how we see big picture trends. But when we actually get down to what we do on a weekly basis or monthly basis, recommending individual stocks, it's so much different, right? Like the market could be up 18%, but some great
Sure.
company, some great small cap could be up 12% or whatever, have 150% upside, like a great opportunity. So it's always so contextual. that. I think the big picture stuff is like a guiding light, and then it's taking that and finding the opportunities within that to be laser focused to try to significantly outperform the market, whether it's going to go up or down, right?
So last question, you, like every analyst at Cabot, loves to forecast things. We all have a crystal ball here. I think that's the saying, right? Um,
Yeah.
uh, where do you see small caps a year from now? Outperforming the market? I think you've mentioned here that they historically outperform the large caps on what, 3 out of every 5 years, and it's been a few years now. I don't know exactly how many, but do you think that the rate, let's say from rate cut to a year after rate cut, first rate cut, do you think they outperform?
Yeah, I'm trying to look at my chart here, and I'm also wondering what the hot sauce penalty of being wrong
I
here
know
is.
this video, just double record this, Madison. But
I
hey,
mean,
I'm rooting for you to be right, because then the more we're right on this, the more people will listen to us.
I mean, it wouldn't. It's a little aggressive, but it wouldn't surprise me if at the index level a year from now, small caps are up, 15 to 20%. That doesn't seem like outside the realm of possibilities. I know, like on the screen, my eyes are looking up here because I'm looking at different levels on this chart. Um, I mean, we small caps right now, the S&P 600 small cap index is flat with where it was in 2021. I mean,
Right.
that is at this time in 2021. That's 3 years
But
ago,
down from the end of 21, right?
but down from, it's a little bit hard to tell on. Yeah, yeah, slightly down.
Slightly down.
Um, so this gets back to the makeup potential, right? Um, but yeah, I'll put it out there, 15 to 20%. Send me the sauce, and just keep it on the shelf for a year, and hopefully after that.
So I think that was something of a loaded question because Chris came on here a few weeks ago and
Yeah.
he
I,
was of the
I did
opinion
I did even better than 15 to 20%, or
that the
not better,
Russell
but more bold.
that the small caps as measured by the Russell, I believe, would hit
Yeah.
all-time highs before the end of the year. It sounds like based on what you're saying that you don't expect that to be the likely outcome.
Uh, well, let's see. No, before the end of this year?
Yeah.
Calendar year, yeah.
Oh yeah, no. That I think that definitely has potential. I mean, we're right there right now. We're close, right? So it
10,
wouldn't take
10%
much.
away. Russell all-time high November 5th of 2021 at 2437. So he's 10% away. So I think Chris is maybe a little bit worried about catching some hot sauce at the end of the year.
Don't be swayed by Brad's general market pessimism. Go big.
No, I'm with you, Chris.
Yeah.
I'll drink to that. I'll drink to.
Okay.
Um, I have a question for you guys. Well, for Brad, if I may.
Yeah.
Brad, I hear that that your wife got a new car,
I'm
and
glad you pivoted from you to your wife.
and I'm wondering while we're talking strategy, what's the strategy for getting that car out of the garage, out onto the highway and back without her knowing or noticing the mileage? Is it like a Ferris Bueller's type thing where we're going to set up some jacks and spin the tires backward, or how does that all work?
So that's like a triple no because the weight of the EVs make jacking them up a big pain. So there's like roadside assist on it. Like if I have to, like I can't. They don't even give you a spare tire. They give you a pump and spray, which then throws off wheel alignment. But so instead of a spare tire, you have roadside assist and an electric pump. She is eyeballing the miles because we got it with like 5 miles on it. So that's a no-go. And the phone as a key feature on it the app tells you where the vehicle is and alerts you. There is literally no way I can pull that off.
After she goes to sleep, maybe just do a little joyride through the streets of Phoenix.
I can take it at my discretion. I just I don't know. I don't want to be the one I'll let it get its first ding, and then I'll unleash it on the highway. It does have hands-free driving on the highway, which we have not used yet.
Oh, that's scary. I don't know if I can.
Yeah.
Yeah, Tyler, we decided that we're going to do a weekly segment. Brad, have you driven your car yet? Your Ford Mustang or Mach-E?
Yeah.
Mustang
Yeah.
Mach-E? Yeah.
Or maybe we could do like an analysts in Mustangs talking stocks segment.
Yeah. Yeah, there we go.
Aren't you guys in the Northeast? I don't know if we need a
what's a
cross-country.
flight?
Yeah, cross-country
Yeah,
flight so you
make it
can
happen.
ride my wife's. My wife will just chauffeur us around because I'm not
Tyler
allowed
will
to.
drive your car before you do. Yeah.
God, no.
Before we go, so for people who want to sign up for Cabot Small Cap Confidential, which is the advisory that Tyler runs, we actually have a deal for people who are listening to today's or watching today's podcast on YouTube through cabotwealth.com/street. You can go to that website, cabotwealth.com/street. We'll put it in the blurb on the YouTube channel. You can get all access to Tyler's entire small cap confidential portfolio and everything that comes with it for 65% off the normal price. And that's with a 30-day, 100% money back guarantee. So you can try it out for a month and see if you like it, give it a test drive. Not to step on Brad's dreams, but it's a monthly advisory. You get 12 monthly issues, and there's a new small cap stock every month, and regular updates on just what's going on in the world of small caps. Plus, if you sign up now, you get a free special report, The Truth About AI Stocks. We touched on AI earlier, plus 2 AI companies to own today. And you get access to Tyler, basically. Tyler's good about responding to emails. So again, that's cabotwealth.com/street. 65% off the normal price for Small Cap Confidential for people who want to sign up for Tyler's service. Anything to add to that, Tyler?
I think you did a great job covering it, Chris. But yeah, no, sounds good. Hopefully we'll get a couple of people subscribing. We have some pretty good content, and there's a lot of stuff that's pretty exciting going on in the small cap realm right now. So
I think the timing is good. I think we're all thinking, well, you and I think the timing is good. Brad seems skeptical, but
I'm not a skeptic. I'm not a secret bear. No, look, Tyler's research is really impeccable. Just as somebody that reads all of Cabot's content, just Tyler's research is I want to say, I don't want to say second to none because all the research is good, but it really stands out because I think it appeals to the sort of the macro and the deep dive part of me. So I cannot endorse his writing highly enough. Just
Oh, Brad,
exceptional
that's very
research.
kind of you. Thank you.
I would say that even if you weren't on this episode. So it's true.
Well, that's a good place to end. Tyler, thanks for joining us. Let's hope that you and all small cap investors connect with the football this time. Let's hope that we're all rooting for Charlie Brown here, and I think it's going to happen. And if once it does, we'll have you back on and we'll celebrate it.
That sounds like a plan. And lastly, from me, Chris, happy birthday. Speaking of celebrating, hope you have a good
50.
Stop. Thank you. Well, that does it for this week's episode of Street Check, and we'll see you again next week.